most people will get their first mortgage wrong, not because they're careless, but because no one really explains this stuff properly. It's full of jargon, outdated advice, and people who really make this more complicated than it needs to be. So if you're thinking about buying your first place and you want a clear, simple breakdown, this video is for you. I'm going to walk through how mortgages actually work in Canada, what the key terms really mean, and how a lender looks at your file. Also, we'll talk about the stuff that no one tells you that can cost you thousands of dollars. So let's start with the basics. And guys, don't worry, this isn't a financial lecture. It's just simple advice if you're at this stage. So what is a mortgage? Well, a mortgage is a loan that is used to buy a home. It's secured by the home itself. That means if you don't repay that loan, the lender can take the home or the property. You will pay a portion of the home's price up front, which is your down payment, and the lender with the mortgage or the loan will cover the rest. You'll pay it back every month with interest over a long period of time, typically 25 to 30 years. But that's just the high level view. It's not just about borrowing money. A mortgage is a bundle of different decisions. Things like fixed or variable rate, a 5-year term or a 3-year term, 25-year amortization or a 30-year amortization. Do you have an insured mortgage, a conventional mortgage? What are your prepayment options? What are your penalties? What's your portability look like? All of those will impact how much you pay, how flexible your mortgage actually is, and potentially how stressful it might be later on. So let's walk through what actually matters. When a lender looks at your mortgage application, they're really trying to answer one simple question. Can this person afford this loan, and will they pay it back on time? To figure that out, they will look at a few things. First, they'll look at your income, the job type that you have, the consistency. Are you self-employed or are you salaried? Then they'll look at your debts, things like your credit cards. Do you have a car loan? Do you have lines of credit? Then they'll look at your credit score. Ideally, they want this over a 680, but you can still qualify if it's underneath. Then they'll look at the property. They'll want to know if it's in good condition. Is it marketable? Is it in a good location? And the big one that they look at here is the mortgage stress test. Because in Canada, you must prove that you can afford your mortgage payment not just at your contract rate, but at a higher rate. It's either 5.25% or your contract rate plus 2%. Really, whichever one is going to be higher. The reason they do that is because lenders want to make sure that you won't default if the rates happen to go up. This stress test rule does affect your purchasing power, typically by 20 to 25%. So even if you feel like you can afford a $700,000 home, the bank might actually cap you closer to $550,000. Whereas if you work with a mortgage broker, you can often explore multiple different lending options that can give you more flexibility. That's why it matters who you actually work with. A traditional bank can only offer you their own products. A mortgage broker, on the other hand, can shop the entire market. They can look at major banks, credit unions, monoline lenders, and find the right structure based on your specific situation. When a lender looks at how much you qualify for, they're going to apply 2 key ratios to your application. The first is GDS, which stands for Gross Debt Service Ratio. It's basically your housing costs. Think your mortgage, your property tax, your heating, and your condo fees. This must stay under 39% of your gross income. Then we have the TDS, which is the Total Debt Service Ratio. It's the same as the last one, but this one will include all of your debt payments. Car loans, credit cards, lines of credit, and that must be under 44% of your gross income. These aren't just rules, they're more so designed to keep your mortgage sustainable, so you don't drown in mortgage payments every single month. Now that we've covered how lenders will decide what you qualify for, the next step is understanding what kind of a mortgage you're actually going to get, because not all these mortgages are created equal. The type of mortgage that you get will depend on how much money you're going to be putting down and whether mortgage insurance is going to be part of your picture. First, we have the insured mortgage. This is when you put less than 20% down. And in this case, you are required to get mortgage insurance, typically from CMHC or another provider. This insurance does not protect you as the borrower. It protects the lender if you stop making payments. Think of it like a safety net. If something goes wrong and you can't make those payments and you default, this insurance will protect the lender. The way it works is you will pay a one-time insurance premium, which is added to your mortgage. It's not fun to pay, but oddly enough, it may actually have some benefits. Next, we have the insurable mortgage. And this is when you put 20% down or more, and the mortgage still meets the insurer's guidelines. Things like property type, value, and amortization. You're not paying the insurance yourself, but the lender still might insure the mortgage on their end to provide them with some flexibility or security, and sometimes that might mean a slightly better rate for you as the borrower. And finally, we have the conventional mortgage. You're still putting down 20% or more, but this time there isn't any insurance at all. Not from you, not from the lender. It's just an agreement with you and the lender directly. It's the cleanest structure, but it doesn't always mean that you're going to get the lowest rate. Here's the surprise. Those insured mortgages that we talked about, they often come with the lowest rates. Why is that? Because the lender's risk is now covered. If you default or if you stop making those payments, the insurance will pay them back. So yes, if you go with the insured mortgage, you do have to pay the insurance premium, but that lower rate can sometimes save you more in the long run, which is why in some cases, putting down less can actually give you a better monthly payment. There's no one size fits all here. The right structure, the right mortgage will depend on your lifestyle, your goals, your current cash flow, and how long you plan on staying in this home. Now that we've talked about the different types of mortgages and how your down payment can affect things, it's just as important to talk about what kind of mortgage you have and how it actually works day to day once you're in it. That's where fixed versus variable comes in. And it's one of the biggest decisions that you'll make as part of your mortgage. To start off, the fixed rate, this is the most predictable. Your interest rate and your monthly payment will stay exactly the same for the length of your term, which is usually 5 years. It's simple, it's stable, and it makes budgeting quite straightforward. If you like knowing exactly what's coming out of your account every single month, the fixed rate is usually going to be the best fit for you. Then we have a variable rate. This one changes. This is tied to the Bank of Canada. If they raise or lower rates, your mortgage will follow. When rates drop, you can save money. But if they rise, your payments might go up too. It can save you money in the long run, but you need to be comfortable riding that wave of unpredictability. Then we have static variable. This is kind of a hybrid. Your payment stays the same month to month, but behind the scenes, more of your payment goes to interest when rates rise. It feels safer, but if rates keep going up, you could hit a point where your payment doesn't even cover the interest portion. So which one is best? Well, it really comes down to you. Do you sleep better knowing that your payments won't change? Or are you more comfortable with short-term ups and downs if it means potentially saving money over time? Also, a big reminder, please always ask about penalties, because fixed terms, they often come with a much higher penalty if you happen to break your mortgage early, if you refinance, if you sell, if you move. Whereas with a variable, penalties are usually much cheaper, typically just 3 months of interest. It's important knowing how your mortgage behaves because this isn't just about peace of mind, but it can actually save you thousands of dollars. Now that we've got a feel for how different mortgage types work and what your payments might look like, let's zoom out a bit, because how long you'll hold that mortgage and how long it takes to pay off matters just as much. That's where terms and amortization come in, and they're two of the most misunderstood parts of the whole process. The term is how long you're committing to your current mortgage deal, your rate, your lender, the contract. Most people in Canada will go with a 5-year term. So at the end of that term, you can renew or you can renegotiate based on the market at that time. The amortization is the full length of your mortgage, how long it would take to completely pay it off if you made regular payments the whole way through. In most cases, that's typically 25 or 30 years. It's more of the big picture timeline rather than the short-term deal that you're signing today, but the long game of actually owning your place outright. So just to be clear, you're not locking in a 25-year rate. What you're in is typically a 5-year deal with a 25-year or a 30-year repayment plan. Now here's where it gets practical. A longer amortization will give you a lower monthly payment, and that can make things feel more manageable, especially if you're dealing with other life expenses, groceries, daycare, car payments, or you're starting a new job. But the catch is you will pay more interest overall, whereas a shorter amortization will mean higher monthly payments, but you get to build equity much faster and you pay less interest over the long term. My recommendation is not to focus on what looks good on paper, but think more about your budget, what fits your lifestyle right now. because the key is making your mortgage work for you rather than the other way around. All right, now that we've covered how long your mortgage can actually run for and what kind of payments you might be dealing with, we can zoom back out again. Because whether you're buying next month or next year, your credit score and your documents are going to play a big role in what you actually qualify for. So here's what lenders are looking for and what you should try to have ready. And this part is not super exciting, but it is one of the more important pieces in being prepared, because without the right credit score and the right documents, it's hard for any lender to give you the green light. All right, let's start with credit. You don't need a perfect credit score. No one's asking for an 850, but most lenders, they do want to see at least a 680 if you want to access some of the best rates and have more flexible options. If you happen to be below that, it doesn't mean that you're completely out. It just means we need to be more strategic with who we approach in terms of lenders. What the lender is looking for is consistency. Payments made on time, no recent collections, no big red flags. You're not maxing out your credit cards, and ideally, you're using less than the 50% of your available limit. All right, now let's talk about the document side of things. Here's what you'll likely need if you apply for a mortgage. First, your proof of income. This could be pay stubs, T4s, or a notice of assessment from CRA. Then you'll need a 90-day bank statement to prove your down payment is legit and you didn't just borrow it last week. Then you'll need valid ID and a list of current debts. And eventually, when you've found a place, you'll need a purchase agreement. Also, another heads up, if you guys are self-employed, lenders will usually want to see 2 years of tax returns to prove that your income is steady. Ultimately, the smoother and more organized we are with all this stuff, the faster your file moves and the more negotiating power you actually have. This part isn't about having the most perfect application either. It's about being prepared. We've covered what lenders are looking for and what you need to have ready. But even with all that info in front of you, it's easy to fall into a few common traps, especially if this is your first time walking through it. So before you make any big decisions, let's walk through some of the most common mistakes we see with first-time homebuyers and how to avoid them. Here are some of the classic traps first-time homebuyers fall into. And it's not because they're careless or reckless, it's because no one has taught this stuff, and it's easy to miss the fine print. So let's walk through some of the big ones. The first one is waiting too long to speak to a mortgage broker. You don't need to have everything figured out. In fact, the earlier that you start, the more options you'll have. Planning will always beat scrambling or panicking later on. The next one is getting fixated on rate. And I get it. Everyone wants the lowest rate. But sometimes that lowest rate that you love can come with major restrictions, like huge penalties if you break your mortgage early and no ability to refinance. Your rate matters, but it isn't everything in your mortgage. And here's the question that I always ask people. Do you want the lowest rate or do you want the lowest total cost over time? Because they're not always the same thing. The next is just going directly to your bank. Your bank might feel familiar to you, but they can only offer you their own lending products, whereas a mortgage broker is able to shop a dozen of different lenders for you to find what actually fits best. Your bank isn't going to reward loyalty here either. They're just going to offer you what they've got. So I'd recommend it's worth seeing what else is out there. Next is skipping the fine print. Things like penalty, portability, refinance options. They're so easy to ignore when you're excited to buy, but these can come back and bite you in the ass and cost you thousands of dollars if you need to make a change down the line. The last one is not knowing your own numbers. If you don't know what you can afford per month, not just in theory, but in your real life, it's so easy to overextend yourself. Know your numbers first, then you can build a plan around that. Avoiding these mistakes doesn't require being a mortgage expert. It just means slowing down, asking questions, and working with someone who is going to explain this stuff clearly. If you guys have made it this far, you're clearly ahead of most people. Because getting a mortgage isn't about being perfect. It's about how you make smart moves that can actually fit for your life. So if you have questions, or if you just want someone to walk you through your numbers and help you build a plan, reach out. My link is in the description below. You can text me, email me, whatever. And if this video did help, please hit subscribe. I've got more videos coming out just like this to help first-time homebuyers feel confident about their next step. As always, thank you for watching.